Hello everyone. So today I'm going to talk about the inverted yield curve. So the goal of this webinar is to spark your interest on how the inverted yield curve lead to a financial crisis and impact market prices such as gold, oil, indices, and others. Now, a bond is a debt instrument that is issued by a government or a corporation for a defined period of time to generate funds, and it's paid back to the investors as principal, adding to it the interest rate. As we can see, this is the corporate bond, where we should mention the issuer name, the face value of the bond, the interest rate to be charged, the name of the company that the bond has been issued to, and the date of maturity. Now we have 4 categories of bonds, such as corporate bonds, as we mentioned, the governmental bond, which we will be discussing governmental bonds, specifically those issued by the US government, also known as treasury bonds, the municipal bonds, and finally the agency bonds. It has many advantages and disadvantages. So first we're gonna begin by the advantages. So when we issue a bond, we receive income through its interest payments, and it is held until maturity, where we're gonna get all the principal back, and we profit when we resell the bond at a higher price. But concerning the disadvantages, bonds usually pay out lower returns than stocks, and companies can default on your bonds, and we also know that bond yields can fall down. So why do people buy bonds? Because they provide a predictable income stream, and typically bonds pay interest twice per year. And if the bonds are held to maturity, bondholders get back the entire principal price, so bonds are a way to preserve capital while investing. And bonds can help offset exposure to more volatile stocks holding. And companies, governments, and municipalities issue bonds to get money from various things, such as providing operating cash flow, financing debt, and funding capital investment in schools, highways, hospitals, and others. Now, what is a yield curve? So it allows investors to compare similar treasury investments with for sure different maturity dates, and its shape helps to forecast interest rates, and treasuries are plotted according to interest rate. And the purpose to use the yield curve is to balance between the risk and reward. So here is a definition of the yield curve, which is a graphical representation that shows the relationship between the interest rate and the time to maturity of the debt, typically for a set of government bonds. And in most cases, it plots the yields on bonds with similar credit quality but different maturities. And the yield curve is an important tool in finance and economics because it provides insights into the market's expectations about future interest rates and the overall health of the economy. And it can take different shapes, which can signal different economic conditions. So here we can see 3 shapes of the yield curve. So if you can see, here is the normal shape of the yield curve, or we can say about it as positive or an upward yield curve. And here we can see the flat one, the flat yield curve, and here is the shape of the inverted yield curve. And as mentioned before, it is the relationship between the interest rate of the yield curve and the maturity date. So if the yield curve was in a positive or upward sloping curve, the yields of shorter maturities here are lower than longer maturities. So the yielded curve is in a normal situation. So we can say about it as a positive curve, and which is why some define it as the normal curve. And in such situation, investors expect economic growth, so that expectation eventually leads to inflation and higher interest rate. As we can see in this graph, the interest rate is growing in a positive correlation with the maturity. So higher interest rates are negative for longer maturities. Hence, investors demand a higher yield to compensate for the risk. So since the 2008 crisis, economic growth expectations were constant, which resulted in a positive sloping yielded curve. Now here is a shape of a flat yield curve, so which result for short and long-term maturities are roughly equal. The interest rate was still the same. So it is usually a transition from positive to inverted or vice versa. Now on the opposite side, the inverted curve occurs when the yields of shorter maturities are higher than longer maturities. So it forms when investors expect economic growth to stop. Therefore, demand for shorter yield maturities will increase, while that of the long term will decrease. Now, how does the yield curve predict crisis? The answer lies in inverted yield curves. So let's go back to the Great Depression. Now I'm gonna explain more about the Great Depression, which happened between 1929 and 1939. So it is considered the most severe economic crisis of the past 100 years. So here, as we can see in this graph, the blue line represents the return on the American government bonds. So as we can notice, it started inverting here at 1929, so a year before the crisis, which began at 1929. Okay, here we can see the inverted yield curve. And concerning the orange line, which represents the Dow Jones Industrial Average, and we also know that it reflects the performance of 30 large publicly traded companies in the United States. So oftentimes it serves as an indicator for the overall performance of the US economy. And this index is highly liquid and very attractive to traders, such opportunity to be represented by GoDo as can trade with the Dow and many other indices. So here, if you invest in our company, you can also have a big opportunity to trade with Dow Jones. So as we can notice in this graph, the yield inverted, showcasing an early signal for a crisis. At the same time, Dow rose highly here, as we can see. So if you look at the index price separately, you might think that the US company is performing greatly. However, a few months after the inversion, the crisis started, and with it, the index's price dropped significantly by 80%. So what we can conclude from this discussion is two matters. So the inverted yield curve predicts the crisis, and there are variations between the yield curve inversion and the recession. So when we have an inverted yield curve, there are high probabilities to have recessions. Now let's see the 2008 financial crisis. So here, as we can see, the yield curve inversion occurred in December 2006. So it took about 16 months before the recession materialized. Now, similar to the previous situations, the Dow Jones index price rose between 2006 and 2008 before dropping significantly. So here we can see how the Dow Jones has dropped. Now the curve turned positive coming out of the crisis in here. Nonetheless, it provided an early signal for the 2008 global crisis. So in 1969, the yield curve inverted in June, and 5 months later, the recession took place. Also, the recession followed the year of 1889 inversion by 12 months, and that of the year 2000 inversion by 8 months. The same thing happened in 1974. The yield curve inverted, and a few months later, the crisis occurred. And in 1979, the yield curve inverted 12 months later. The recession played out. However, it took the recession only 8 months after the 1981 inversion. In the latest two scenarios, unlike others, the recession signal was so strong that the stock didn't even rise temporarily, they declined immediately. So in the 1970s, inversions are not close to what we are seeing today, as the prices in the market are increasing. Now, in the current situation, in August 2022, as seen in the figure, the yield curve inverted, that is 14 months ago. We can see in the following graph that the gap between 2-year and 10-year treasury yields was the most inverted since 1981. And this is the same recessionary signal we received over different periods. So note that the depth of the inversion signifies how strong the upcoming recession will be. So in the 1970s, inversions are not close to what we are seeing today, as the prices in the market are increasing. And in the 1970s are considered as an exception because in that period, the oil prices rose to some very high levels. So the oil price in the 70s went from $3.5 to $10 in 1 month only. And that increase impacted the consumers and their purchasing powers and elevated operational costs for companies, leading to high unemployment and low demand for goods. Now, what happened in 2022 was very much different. So the oil shock caused in February by the Russian-Ukrainian conflict did not impact the consumption. And this is because the American consumers had a $2.5 trillion excess of savings. So today's conversion is more similar to that of 2006 than those of the 70s. And this condition was very much similar. Following the recession, the unemployment rate remained high, and also the prices in the market kept on increasing. So the yield curve inverted in August 2022, that is 14 months ago, and for now we still have no recession and the market prices are increasing significantly. However, it took 16 months between the 2008 crisis and the 2006 recession. Now remember that the situation was also similar to 1929 inversion, when we saw for about a year and a half the stock prices rising and the employment rate remaining low before the crisis eventually struck. And remember also that the depth of the inversion reflects the size of the recession. So in short, the inversion today is similar to 2006 and 1929 in 3 ways: the extent of the inversion, the market prices, and the unemployment rate. And note that the 2022 inversion has the same depth as 1929's and a lower one than 2006. So we will see for how long the prices in the market will continue to rise and what will transpire. And in such a crisis, the economy suffers, and with it, the lives of people. You should not only seek to protect yourself financially, but also capitalize on the opportunity to secure big profits. And here are some recommendations in such a situation. So, what we should buy, so the things that we should buy are precious metals such as gold and silver, US Treasuries bond examples include 10-year or 30-year US Treasury bonds, high-quality dividend-paying stocks, defensive sectors like healthcare and utilities, like healthcare companies such as Pfizer or Johnson and Johnson, and etc. Safe haven currencies like the US dollar and Swiss franc. Consider holding or buying US dollar and Swiss franc to benefit from their status as safe haven currencies. Now, what we should sell: risky or highly leveraged assets such as companies with high debt, stocks with weak financials or high debt. For example, consider selling stocks of companies and industries that are particularly vulnerable during a crisis, such as heavily in-debt airlines or highly leveraged real estate firms. Speculative investments such as speculative investments could include such as Bitcoin. We should also consider selling currencies of countries facing severe economic turmoil or political instability, like the Argentine peso during its economic crisis. And high-risk bonds or junk bonds from companies with poor credit ratings may be sold to reduce risk exposure. And finally, liquid assets that are hard to sell in a crisis, such as real estate. Thank you for watching.